Good morning. Here is the whole week in one sentence. The artificial intelligence trade did not get a verdict. It got a margin call. A fund running roughly 4 times leverage was liquidated into Citadel's hands. 3 times levered retail chip funds had their assets cut by about 2/3. Korea's stock market printed its worst month since 1997 and then turned around and printed the single largest one-day gain in its history. And in the middle of all that violence, Amazon reported its cloud division growing 37% and raised its capital spending plan for this year to about $220 billion. Prices said the build was over. The cash flows said it is accelerating. When those two disagree that loudly, the thing that broke is usually leverage, not demand. This is the Asymmetric Daily Brief for Friday, July 31st. Here is the board, and today it reads like 2 different markets stapled together. The S&P 500 is around 7,416, up 1.36% on Thursday's close, with futures higher again. The KOSPI is the headline, 6,695.45, up 17.91%. That is the largest single-day gain in the index's history. Hold that number next to this one. The same index just finished its worst month since 1997, down 22.19%. Both facts are July. Now the row that actually governs everything. The 30-year Treasury yield is near 5.23%, a 19-year high, after jumping as much as 14 basis points following the Federal Reserve meeting. The 10-year is around 4.67%. Gold is about $4,110 an ounce, down 1.2%, holding just above $4,100 on an overnight pause in strikes on Iran. Brent crude is $89.57, and it is up more than 20% on the month. Bitcoin is heavy at roughly $63,829. West Texas Intermediate is 84.23, and the volatility index is 18.01, down almost 13%. Fear drained out of this tape remarkably fast. First contrarian read, and it is the spine of the week. Everyone is narrating this as the artificial intelligence bubble popping. Look at the mechanism instead. Situational Awareness, a fund worth roughly $45 billion at its peak and run at about 4 times leverage, took margin calls from Goldman Sachs, JPMorgan, and Bank of America and sold its entire public equity book to Citadel. Its assets are now around $10 billion. 6 days before that forced sale, its founder had written to investors describing the sell-off as some of the most attractive opportunities since early 2025 and invited fresh capital. Underneath that, 3 times levered retail semiconductor funds had their assets cut by roughly 2/3. That is the whole story. Forced sellers meeting a thin bid. And on the other side of the very same week, Amazon Web Services grew 37% to $42.2 billion. Amazon raised its capital spending guide to about $220 billion, and Korea's chipmakers went limit up. The bubble was in the positioning, and it has now violently deflated. The demand never showed up in the confession. Conviction here is high. Second read, and this is today's deep dive. Everyone still believes the constraint on artificial intelligence is chips. It moved. General Electric Vernova's gas turbine order backlog ended the second quarter at 116 gigawatts, up from 100 gigawatts just 1 quarter earlier. Its annual production capacity is being raised to about 20 gigawatts a year, reaching 24 gigawatts in 2028, the target of 30 by 2030. Management expects turbine reservations to be sold out through 2030 by the end of this year. That is a backlog roughly 6 times annual output, and you cannot buy your way to the front of it. Now the demand side. The Texas grid operator's large load interconnection queue went from 63 gigawatts at the end of 2024 to more than 230 gigawatts during 2025, with more than 70% of those requests coming from data center developers. High-capacity transformer lead times have gone from roughly 12 months in 2020 and 2021 to 48 to 60 months today. Morgan Stanley models a United States power shortfall of about 44 gigawatts through 2028. And here is the physical tell. 2 data centers in Silicon Valley are built, finished, and cannot switch on. Because the transformers to energize them do not exist yet. Chips are a supply chain. Power is a construction schedule. Conviction high. Third read, and it is a correction rather than a call. Everyone quoted Amazon's earnings per share at $5.75 against a consensus near $1.82, a triple, but net income of $62.6 billion includes about $53.4 billion of pre-tax non-operating income, and that is overwhelmingly a mark-to-market gain on Amazon's stake in Anthropic. It is not cash. It is not operations. Strip the after-tax portion out and core operating earnings per share lands somewhere near $1.85 to $1.90. A modest beat, not a blowout. Now, this is not a knock on the quarter. Operating income of $27.5 billion, up 43%, is genuinely excellent, and Amazon Web Services at plus 37% is the number that actually matters. The point is narrower, and it cuts both ways. In a week when the entire market was repricing whether artificial intelligence can monetize, the answer arrived in the cloud revenue line, and almost everyone quoted the earnings per share instead. The most quoted number this earnings season is the least informative one. Now follow the money and start with the Federal Reserve, because the reaction mattered far more than the decision. The committee held at roughly 3.6%, with 3 dissents. Then investors dumped 30-year paper, sending that yield up as much as 14 basis points to nearly 5.23%, a 19-year high, while short-term yields actually fell. That combination produced one of the largest steepenings of the yield curve after a Federal Reserve meeting since at least the mid-1990s. Chair Kevin Warsh has ended forward guidance, and a meaningful share of the committee now projects at least one rate hike this year rather than a cut. Asked why he did not move, his framing was that the bond market has been doing the job for him. Read that honestly, and it is a credibility problem, not a policy stance. Bondholders are not demanding more yield because growth is booming. They are demanding it because they do not believe the inflation path. And a 30-year at 5.23% is the single most consequential number in this report. It caps gold. It reprices every long-duration asset, which is to say every artificial intelligence infrastructure story whose cash flows arrive in 2031. And it is precisely why Japan's intervention has a short shelf life. The dollar and the yen. Japan's finance ministry intervened on Thursday after the yen hit a 40-year low near 163.99, driving it more than 3% stronger to about 157.8, and handing the dollar its worst single day since 2022. South Korea sold dollars in coordination. Here is the problem. Intervention changes the price. It does not change the reason. Rate differentials are unchanged. And the United States long end just hit a 19-year high. Intervention buys days, not a trend. Now gold and oil. Gold broke above $4,100 as the United States paused airstrikes on Iran overnight, then eased to about $4,110. That level is being driven by the geopolitical pause and the dollar's slide, not by a trend in real yields, which are moving against it. And here is the most undercovered macro fact in this market. The United States and Iran are in month 6 of a war. Most Strait of Hormuz shipping is halted, and Brent crude is up more than 20% on the month at about $89.57. Refining margins are at record highs. That is the most likely source of the inflation surprise that forces the Federal Reserve's hand, and almost nobody is watching it. A word on positioning and sentiment. Across market and social sentiment monitoring, the conversation this week was overwhelmingly about whether the artificial intelligence bubble had burst, and it was framed almost entirely as a verdict on demand. The mechanism, the leverage, the identity of the forced seller barely registered until the liquidation was already public. There is a second and larger blind spot: energy and the long end. A war in month 6 that has moved Brent more than 20% in a month, and a 30-year Treasury at a 19-year high are the two variables most likely to produce the next surprise, and they are the two least discussed. Meanwhile, on the other side of the artificial intelligence trade, OpenAI cut the price of its cheaper model tier by 80% this week, and the commentary read it as a margin problem. Falling unit prices alongside rising volume is the signature of a real market, not a bubble. When the loudest conversation and the largest variables are this far apart, the gap is usually where the opportunity sits. So here is the tell of the day, and it is two numbers from one company's order book: 116 gigawatts of gas turbines on order, about 20 gigawatts a year of capacity to build them. That is General Electric Vernova at the end of the second quarter, and it is roughly a 6-year queue at full production rate, which is exactly why management expects reservations sold out through 2030 by year-end. Now put the second constraint beside it. High-capacity transformer lead times have gone from about 12 months in 2020 and 2021 to 48 to 60 months today. 4 to 5 years for the equipment that connects a finished building to the grid. Together, those two numbers are the cleanest statement of where the artificial intelligence trade actually binds. Every model in the world is downstream of a substation that takes 4 years to build. The market spent this entire week arguing about whether artificial intelligence demand is real. The interconnection queue already answered. Sectors in play, 3 today. First, memory and semiconductors, the whipsaw. SK Hynix reported an enormous earnings gain with margins above 80%, and the stock fell 7.5% on the print, with analysts carrying 45 buy ratings and 0 sells. 2 days later it went limit up, plus 29.95%, with Samsung up 26.81. The bull case is that the cycle is real and the drawdown was mechanical. The bear case is that when an enormous earnings gain cannot hold a bid, the multiple was doing all the work. The read, both are true, and that is the definition of a positioning unwind rather than a demand break. Second, power and grid equipment, the trade that is not crowded yet. Turbine backlogs at 116 gigawatts, transformer lead times at 4 to 5 years, an interconnection queue that quadrupled. The bull case is a decade-long, contracted, non-speculative revenue stream. The bear case is that it has already re-rated, and a 5.23% 30-year makes every capital-intensive builder more expensive to finance. The read, the bottleneck is real regardless of the multiple. The risk here is the price you pay, not the thesis. Third, energy, the ignored one. Brent up more than 20% on the month with the Strait of Hormuz impaired and a war in month 6. Bull case, physical scarcity with no spare capacity buffer. Bear case, one durable ceasefire headline unwinds it violently, and gold's pop on an overnight pause showed exactly how fast that can happen. The read, this risk premium is live, two-sided, and it is the only macro variable with the power to override the Federal Reserve. On the radar, first, the crypto bill. The Senate calendar is nearly out, and prediction markets have moved hard against it. Polymarket odds on the bill being signed into law this year have fallen from above 70% earlier in the year to roughly 28% now, around record lows. Worth noting that JPMorgan's research this week was quoted in only one direction. The bank did warn that delay pushes tokenization onto traditional finance infrastructure. It also warned that rushing the bill could open loopholes that shift risk into less supervised venues. Both halves are in the same note. Second, Monday's Korean Open. A plus 17.9% day after a minus 21% week is a short squeeze plus retail re-entry, not price discovery. Monday grades it. Third, and above all others, the 30-year at 5.23. If that becomes 5.4, the equity rebound dies regardless of what artificial intelligence earnings do. Fourth, a second Japanese intervention. If the yen slides back toward 163 without one, credibility is gone. Fifth, Iran and the Strait of Hormuz. If the pause holds, the entire energy inflation leg unwinds. If it breaks, Brent above 90 collides with a central bank that cannot cut. And sixth, the one nobody can schedule, the next forced seller. Nobody identified 4 times leverage until the margin calls landed. The honest question is who else is carrying it. The scorecard, 3 new falsifiable calls dated today. 1. The artificial intelligence drawdown was a leverage event, not a demand event. That is falsified if any United States hyperscaler cuts its 2026 capital spending guidance at its next reported quarter. Conviction high. 2, and this is today's deep dive thesis. Power, not silicon, is the binding constraint through 2028. Falsified if General Electric Vernova's gas turbine backlog falls below 100 gigawatts, or if the company publicly states reservations are not sold out through 2030 before the middle of 2027. Conviction high. 3. Japan's intervention does not hold without a change in rate differentials. Falsified if the dollar-yen rate stays below 160 for 30 consecutive sessions with no further intervention and no Bank of Japan hike. Conviction medium high. Now the carry forwards. I'll call that positioning, not valuation, is the transmission channel is strongly supported. This week is the cleanest evidence yet. I'll call that the 10-year holds above 4.5% through the Federal Reserve meeting graded correct at 4.67. And our oil call remains live and being tested, with Brent at 89.57, below 90, but nowhere near the falsifier. And the close, two things happened this week that almost everyone is going to remember wrong. The first is that the artificial intelligence trade crashed. It did not. A fund with 4 times leverage was liquidated, and a levered retail product unwound behind it into a market with no bid. The fundamentals that printed in the very same week were the strongest of the cycle. The second is that this story is about chips. It is not anymore. The queue for a turbine now runs to 2030, a transformer takes 4 to 5 years, and no amount of capital shortens either one. The market spent the week re-rating silicon, while the actual constraint sat in an interconnection queue that nobody reads. So here is the question worth sitting with. If the demand is real and the power is not there, what exactly does the money buy? Today's deep dive takes that apart in full, and it is linked below. I'm Earl. The asymmetric signal. One contrarian read a day. Subscribe. Research and education only, never investment advice.